We were all told that real estate crowdfunding was going to completely change the game. It was supposed to finally swing the doors wide open for everyone to get in on big-time real estate deals. But have you ever looked around and noticed who's not at the party? The really big money. The institutions writing those massive 9-figure checks. Well, today, we're going to pull back the curtain on the uncomfortable truth about why that is.
The initial pitch was incredible, right? You had platforms like Fundrise and Kickstarter promising to completely level the playing field. For the very first time, the little guy, you and me, could get a slice of the pie, investing in deals that used to be locked away for only the super rich. It felt like the true democratization of finance was finally here.
But a funny thing happened. The biggest players in the game, we're talking pension funds, university endowments, the giant investment firms, they just never really showed up. And that's the central mystery we're diving into today. Why did big money take a pass on the crowdfunding revolution? The answers, it turns out, tell us a whole lot about how the world of high finance actually works behind the scenes. Okay, our first clue is a huge one, and it all boils down to one word: control. See, for an institutional investor, putting money into something isn't just about the potential return. When you're deploying tens or even hundreds of millions of dollars, you're not just buying a piece of the deal, you are buying influence.
And this is where you see the first major clash. It's all laid out right here. On one side, you have the institutions. They demand control. They want veto power, a seat on the board, the ability to negotiate custom fees. They need their hand on the steering wheel. But on the other side, what do the platforms offer? A standardized take-it-or-leave-it deal. It's like they're speaking two completely different languages.
So let's move on to our second clue. Because even if an institution could somehow get past that whole control issue, there's another massive hurdle. The simple, brutal math of the fees just doesn't work for them at scale.
The numbers here really tell the whole story. When you go through a platform, you're getting hit with multiple layers of fees. The platform fee, an advisory fee, the sponsor's fee, it all piles up, sometimes to 3 or even 4% a year. But by going direct, those big players can negotiate all of that down to just 1 or 2%. Now that might sound like a small difference, but when you're talking about huge numbers, it is anything but small.
And here it is, the number that just stops the conversation cold. That little 2% difference? On a $100 million investment over 5 years, that's $10 million. $10 million! Just gone, left on the table, purely because of fees. For a fund manager, that's not just a bad deal, that's a fireable offense. No way! All right, this brings us to the final piece of the puzzle. This is the part that happens behind closed doors, the part nobody really talks about, but it might just be the most important factor of all. It's the simple fact that the absolute best deals, you're almost never going to find them listed on a public website. At the end of the day, high-stakes real estate is a relationship game. It always has been. The top sponsors, the ones with the absolute best track records, they aren't posting their prize deals online. No, they're making 5 phone calls to their most trusted capital partners. These are people they've worked with for decades, people they've met in boardrooms at exclusive conferences, maybe even on the golf course. It is an exclusive world, period.
And this quote just hits the nail on the head. It's not that crowdfunding platforms are bad. The mistake is trying to force square pegs into round holes. They are fundamentally different tools, built for fundamentally different kinds of investors with different needs.
Let's just break this down. It's actually pretty simple when you see it laid out like this. Over on the left, you've got your institutional investor. Look at that ticket size, 20 million plus. Their primary need? Control and scale. So their best path is a direct joint venture. Now slide all the way over to the right. That's the retail investor. The check size is smaller and the number one need is access and simplicity. For them, crowdfunding is the perfect fit. Different needs, different tools.
So this brings us to a really important question. If these platforms aren't for big money, then who are they for? Well, this is where they provide absolutely incredible value, and it's likely for many of you watching right now.
I mean, think about it. These platforms are the absolute ideal tool for someone who wants to dip their toe into real estate investing for the very first time. They are perfect for diversifying your portfolio with just a little bit of money, for investing passively without all the headaches, and you get a simple tax form at the end of the year. Most importantly, they give you access to deals you otherwise would never, ever get to see. But you know what? The story doesn't end here. The industry is always evolving. And those really clear lines we just drew between these different investor worlds, well, they're starting to get a little bit blurry. A convergence is definitely coming. We're already seeing all these new, innovative models popping up that are trying to bridge this gap.
You've got hybrid platforms that offer way more customization, special share classes designed for wealthier investors, even tokenized real estate, which, in theory, could offer the best of both worlds. The industry is actively trying to solve this puzzle.
So what's the bottom line in all of this? If you take one thing away today, let it be this. Crowdfunding democratized access, but it did not democratize influence. And that is such a crucial distinction. It gave more people a seat at the table, which is amazing, but it didn't give them any say over what's on the menu. And that brings us right back to what big money truly demands. It's this trinity, right here: control over the nuts and bolts of the deal, customization of the terms and fees, and the deep personal relationships that get the best opportunities sent to your door in the first place. Until a platform can deliver on all three of those, the biggest checks are going to stay private. Which leaves us with a final, pretty provocative thought to chew on. What if the real revolution isn't about tearing down that old exclusive boys club where all the big deals get done? What if it's actually about using all this new technology and these new models to build a better, more efficient, and maybe just a little more accessible version of it? What do you think? Thanks for watching.